Right now, the biggest bottleneck to the trillion-dollar artificial intelligence boom isn't, silicon chips.
No, definitely not.
Right. It isn't a shortage of software engineers, and it certainly isn't a lack of venture capital. It is, honestly, copper wire.
Yeah. Copper wire, old school utility poles, heavy duty transformers.
Exactly. The physical transmission grid.
Yeah.
We are basically watching the most advanced technology in human history slam headfirst into the hard physics of electricity generation.
And, the market is just now waking up to the reality that you cannot deploy a massive gigawatt scale AI training cluster if you can't actually plug the thing in.
Right.
I mean, the data center pipeline is just completely bottlenecked by the grid right now.
Which is wild. So, welcome to Talk Tickers. Today, we're pointing our lens directly at a company sitting dead center of this physical bottleneck.
PPL Corporation.
Yep, ticker symbol PPL. We've gone through the raw transcript of their Q1 2026 earnings call, dissecting the commentary from their CEO and CFO.
And our mandate here is what it always is, right? We are cutting through the Wall Street jargon to extract the hard data for you.
Exactly. We're analyzing the underlying mechanics, and we're delivering a definitive, highly opinionated verdict on whether this stock is a buy, a hold, or a sell for the retail investor.
It's such a compelling setup, too, because PPL represents this really fascinating collision.
Oh, totally.
You have the defensive, highly regulated nature of a legacy utility clashing directly with the unregulated, just hyper-aggressive growth demands of the world's largest tech hyperscaler.
Yeah, it's a weird mix.
The Q1 print tells a very specific story about how management is trying to balance those two identities.
So let's get right into the headline numbers, because on the surface, they delivered exactly what the street modeled.
They really did.
PPL reported GAAP earnings of 60 cents per share, but ongoing earnings landed at 63 cents per share.
Right, which is a 3-cent increase year over year from Q1 of last year.
And more importantly, for the big institutional holders, they reaffirmed their full year 2026 guidance.
Keeping that midpoint target locked at $1.94.
Which is exactly what you want, right?
Yeah.
I mean, for a regulated utility in the first quarter, the primary objective is zero downside surprises.
Exactly. Reaffirming the $1.94 midpoint instantly signals to everyone that their core rate base growth is tracking right alongside their internal models.
But, looking closely at the bridge between that 60-cent GAAP number and the 63-cent ongoing number, it reveals a lot about the friction they're dealing with.
Oh, for sure. They took a 3-cent hit from special items, and those weren't just standard accounting adjustments.
Right. The transcript details an ISO New England transmission ROE reduction, some specific meter system integration costs, and the regulatory asset treatment of an IT transformation down in Kentucky.
Let's zero in on that ISO New England ROE reduction for a second.
Yeah, let's do that. Because for a transmission owner, getting your return on equity clipped by the independent system operator is basically margin compression dictated by fiat.
Right, exactly.
So how much of a structural headwind is that FRRC level regulatory pressure right now?
Well, I mean, it's a persistent risk, but it's a known risk. When FERC or a regional operator steps in and shaves a few basis points off the allowed base ROE, it instantly hits EPS.
Because that revenue flows almost entirely to the bottom line.
Exactly. However, PPL's geographic diversification kind of isolates that risk. The hit in New England was a one-off adjustment that management effectively just walled off from their ongoing operational metrics.
Makes sense.
To me, honestly, the far more interesting accounting maneuver was the IT transformation in Kentucky.
Oh, because they secured regulatory asset treatment for it.
Yes. Instead of taking the massive software and systems overhaul as a direct hit to the income statement in Q1.
We would look terrible.
Right. The Kentucky Public Service Commission is letting them park it on the balance sheet and just amortize it into the rate base over time.
It's a brilliant cash flow defense. Utilities are uniquely positioned to use regulatory assets, but they still have to actually convince the commission that the IT upgrade benefits the ratepayer.
Usually through better outage management or like billing efficiency.
Right, and getting that approved smooths out the earnings trajectory. It prevents a sudden spike in operating expenses that would otherwise completely terrify the equity markets.
And speaking of terrifying the equity markets, we have to look at the sheer scale of the capital they are raising to fund all this grid expansion.
Yeah, the CFO highlighted that they executed a $1.15 billion equity units offering, and that settles in 2029.
He claimed this de-risks about 2/3 of the total equity needed to support their current multi-year CapEx plan.
Okay, so I see the advantage of locking in the funding now, especially with, a $23 billion CapEx runway through the end of the decade.
It's massive.
But paying the coupon on the debt component of those equity units in a high rate environment has to be dragging on their near-term cash flow, right?
It does. So why not just use their at-the-market facility for the whole thing and avoid the complex bundled instrument?
Well, that really comes down to minimizing immediate dilution while managing the weighted average cost of capital.
Okay.
An ATM where they are just trickling common stock into the open market daily is highly efficient for smaller capital injections.
Sure.
But if you try to dump $1.15 billion of equity through an ATM over a single quarter, you are going to suppress the stock price hard.
Oh, definitely.
So the equity unit is basically a masterstroke of timing. By bundling a debt instrument with a forward purchase contract, they secure the institutional capital today.
So they can start ordering those long lead time transformers and switchgear.
Exactly. But the actual issuance of the shares, the real dilution event, is delayed until 2029.
Oh, wow. So they are essentially betting that by 2029, their rate base and earnings will have grown enough to absorb that new share count without a massive EPS contraction.
You nailed it. It perfectly aligns the dilution with the period when those capital investments actually start generating revenue.
Right, because if they build a new substation today, it isn't earning a return until it's operational and approved in a rate case.
Exactly. Deferring the equity settlement protects the current dividend yield, which, let's be honest, is the primary reason you, the retail investor, are holding this stock in the first place.
That brings us perfectly to the operational tug of war beneath those top-line earnings. Hitting the guidance numbers is great, but looking at the income statement, they fought a massive battle against the weather to get there.
They really did. The CFO explicitly cited lower sales volumes due to highly unfavorable weather compared to Q1 of last year.
Mild weather is basically the silent killer of utility earnings.
It is. If heating degree days come in significantly below the historical average, your volumetric sales just plummet.
But this is exactly where PPL's operational leverage showed up, right? The fact that they still posted a 3-cent ongoing earnings increase despite a mild winter.
Right. That means their core base rate growth completely outmuscled the volumetric decline.
And the primary driver of that outperformance was the base rate recovery in Kentucky. New retail rates went into effect on January 15th.
But the transcript reveals some real friction there.
Yeah, let's talk about that. The Kentucky Public Service Commission actually stepped in and modified the settlement that PPL had negotiated with the interveners.
Which is pretty rare.
The CEO specifically noted they've requested reconsideration. He argued the original settlement was a much better outcome.
Right.
So when a regulatory body overrides a negotiated settlement, my immediate instinct is to view that as a massive red flag for future capital deployment in that state.
Well, I read it slightly differently.
Oh, really?
Yeah. I mean, it's definitely regulatory friction, but it isn't a thesis breaker. In utility regulation, a black box settlement negotiated between the utility, the industrial consumers, and the state attorney general is usually a really finely balanced compromise.
Okay, sure.
When the KPSC modifies it, they are usually just tweaking the exact ROE or slightly altering the depreciation schedules.
Right.
The CEO's frustration is palpable, absolutely, but he also explicitly stated that even under the modified order, PPL can still achieve its targeted financial metrics.
So the commission gave them a haircut, but they left enough meat on the bone to keep the EPS model intact.
Exactly. And demanding reconsideration is just standard posturing. You have to push back to establish precedent for the next rate case.
Right.
The far more important takeaway for the investor is that the new rates are now actively flowing into the income statement. The regulatory lag in Kentucky has been successfully reset.
Okay, let's pivot and talk about regulatory credibility.
Yeah.
Because the operational data out of Rhode Island is arguably the most impressive non-financial metric in the entire call.
Oh, absolutely.
In late February, Rhode Island Energy got hit with a historic blizzard. We're talking 40 inches of snow and hurricane-force winds.
Brutal condition.
Yet they restored power to 99% of their customers within 48 hours. They vastly outperformed neighboring utilities and were actually formally honored by the state legislature.
Which is a great PR headline.
It is. But as an investor, the tangible result of that goodwill materialized instantly. They secured approval for over $330 million of critical infrastructure investments through their ISR program.
And that transition from operational excellence to capital deployment is basically the entire utility playbook.
Explain the ISR part, because that's crucial.
Right. An ISR, an infrastructure safety and reliability plan, is essentially a fast-track capital recovery mechanism.
Okay.
Instead of waiting for a massive base rate case 3 years down the line, an ISR allows the utility to implement a specialized rider on customer bills.
Which means they begin recovering a return on that $330 million investment almost contemporaneously.
Exactly. The rider recovery minimizes the regulatory lag to near zero.
That's huge.
It is. But regulators are heavily scrutinized when they approve these riders. If a utility has a history of poor reliability, the public advocates will fight the ISR tooth and nail.
Obviously.
By delivering a flawless response to a historic blizzard, PPL handed the regulators the exact political cover they needed to approve the grid upgrades.
The narrative becomes, we need to fund PPL because they keep our constituents alive during winter storms.
Exactly. That operational execution directly unlocked $330 million of highly visible, low-risk rate base growth.
Which perfectly sets the stage for what happened in Pennsylvania. The headline here is just staggering.
It really is.
PPL Electric Utilities reached a settlement in their distribution base rate case, and they casually noted that they had not filed a rate case in over 10 years.
A full decade.
In an environment where we've seen rampant inflation, supply chain breakdowns, and skyrocketing material costs, how does a utility go a full decade without asking the state for a base rate hike?
They did it through ruthless, obsessive cost discipline. The CEO pointed out that over the last decade, they kept their operations and maintenance O&M increases 25% below the rate of inflation.
That's incredible.
They essentially self-funded a decade of grid modernization by structurally lowering their operating footprint.
We're talking about massive deployment of smart grid technology, right? Automated switching, fault location systems.
Yeah, exactly. Things that mean you don't have to roll a heavy-duty diesel truck and a four-man crew out to a neighborhood every single time a squirrel chews through a line.
They swapped manual labor and truck rolls for localized sensors and automated distribution management.
Precisely. By driving O&M into the floor, they kept their return on equity comfortably within the allowed band without needing to touch base rates.
And the geopolitical payoff for that discipline is massive. When they finally did go to the table this year, the resulting bill increase across all customer classes was under 4%.
In a state where energy affordability is a massive hot-button political issue.
Right. During the Q&A, David Arcaro from Morgan Stanley specifically brought up letters from the Pennsylvania governor expressing concern about high utility bills.
Yeah, I saw that.
But PPL's ability to absorb a decade of inflation and only deliver a sub-4% hike makes them politically bulletproof.
It completely neutralizes the headline risk. When the governor complains about rates, PPL can transparently show that their delivery charges are among the lowest in the Commonwealth.
But embedded within that PA settlement is a structural change that is far more important to the future of the stock than the 4% hike.
The new rate class.
Yes, they officially established a new large load customer rate class with a 10-year load requirement and aggressive financial commitments.
This is the pivot point.
This is where the sleepy defensive utility narrative ends and the explosive AI infrastructure thesis begins. Let's transition into management guidance because the numbers laid out regarding the data center pipeline in Pennsylvania are borderline incomprehensible.
It is a complete paradigm shift for the load growth of this company. For the last 20 years, utility load growth in the U.S. has been essentially flat.
Because energy efficiency gains in residential homes offset population growth.
Exactly. Now suddenly, PPL is staring down a development pipeline in Pennsylvania that sits at 28.3 gigawatts.
Let's contextualize the sheer physics of 28.3 gigawatts. A single gigawatt is roughly the output of a massive commercial nuclear reactor.
It's massive.
It is enough electricity to power roughly 750,000 homes. PPL has the equivalent of 28 nuclear reactors worth of power demand sitting in advanced stages of development.
And the CEO was very careful to define what advanced stages actually means. This isn't just a Google engineer sending an email asking about land.
Right, these are actionable projects. He specified that out of that 28.3 gigawatts, 10 gigawatts already have executed letters of agreement or electric service agreements, ESAs, with binding financial commitments.
And 5 gigawatts are actively moving dirt under construction today.
He name-dropped all the heavyweights. QTS, AWS, Powerhouse, Core, Weave. The premier third-party developers and hyperscalers are flooding into PPL's specific footprint.
Which brings up a great point. Anthony Crowdell from Mizuho asked a phenomenal question during the Q&A about this.
Yeah, he pointed out PPL's unique structure. They own a wires-only transmission system in PA and a fully vertically integrated utility in Kentucky. He asked if these hyperscalers have a preference. Why are they choosing the Pennsylvania territory?
And the response highlighted the bifurcated nature of the current data center market.
Okay, unpack that for us.
So the facilities rushing into Pennsylvania are primarily traditional cloud and financial data centers. They are incredibly latency sensitive.
Right.
If you are executing high-frequency trades or running critical enterprise software, your servers need to be physically close to the massive population and business centers of the East Coast.
So eastern Pennsylvania is the geographic sweet spot. Close enough to New York and D.C. for near-zero latency, but far enough away to secure massive acreage.
Exactly, but geography is only half the equation. The real moat PPL has built in Pennsylvania is their transmission architecture.
Right, because the tech companies are locked in a trillion-dollar arms race. They don't care about the cost of power as much as they care about the speed to power.
Yes, they cannot wait 7 years for a utility to permit and string a new 500 kilovolt transmission line.
And this is where that decade of self-funded grid modernization pays off exponentially. The CEO dropped a comparative metric that should have every institutional investor aggressively recalibrating their models.
The connection cost.
Yes. He stated that because PPL's grid is already heavily reinforced and automated, they can connect a gigawatt-scale data center for less than $150 million in total network upgrades.
While pointing out that on peer utility networks, connecting that exact same gigawatt load could cost upwards of $1 billion and take years longer.
That is a staggering competitive advantage.
Yeah.
But how are they physically doing that without stringing new wire?
Paul Patterson from Glenrock asked specifically about grid-enhancing technologies, and management mentioned their deployment of DLR.
Dynamic line rating. This is a perfect example of substituting software for physical steel. Explain how DLR works.
Sure. Historically, utilities use static seasonal ratings. Engineers would look at a transmission line and calculate the absolute worst-case scenario, like a 100-degree windless day in August.
Right.
And they'd set a hard, inflexible limit on how much amperage could flow through that line before the wire got too hot, expanded, and sagged into the tree canopy, causing a fault.
So even if it's actually a cool, breezy Tuesday in May, the grid operator is strictly bound by that worst-case summer rating, leaving massive amounts of physical capacity stranded.
Exactly. So DLR technology attaches real-time thermal and tensile sensors directly to the transmission lines. It continuously monitors the ambient temperature, the solar irradiance, and the wind speed.
Because wind is a phenomenal natural cooling mechanism for power lines.
Yep. By feeding this real-time telemetry directly into the PJM day-ahead market, PPL can dynamically uprate the capacity of the line.
They are safely pushing significantly more power through the exact same legacy infrastructure.
It unlocks gigawatts of latent grid capacity instantly.
It's brilliant engineering.
Yeah.
But I have to play devil's advocate here.
Go for it.
I look at this massive frenzied rush of data centers, and I see the echoes of the dot-com bubble or the telecom fiber overbuild of the late 90s.
Sure, the boom and bust cycle.
If PPL commits hundreds of millions of dollars of capital to build custom substations and transmission spurs for AWS and QTS,
Yeah.
what happens if the AI bubble pops?
That's the big fear.
What if these models become exponentially more efficient and the power demand evaporates? Are the residential ratepayers, the people in Pennsylvania who just got off a decade with no rate hikes, going to get stuck holding the bag for stranded, useless tech infrastructure?
That is the existential question for regulators nationwide right now. And it's exactly why the creation of that new large load customer rate class in the PA settlement is the linchpin of PPL's strategy.
Okay, so how does it protect them?
The CEO was adamant about the financial guardrails insulating the legacy ratepayer. The electric service agreements they are signing with these developers require massive upfront prepayments.
We are talking about the hyperscalers funding the capital upgrades in cash before a single shovel hits the dirt.
And they enforce strict credit support and minimum load obligations, meaning even if the tech company goes bankrupt or the data center sits half empty,
they're contractually obligated to pay for the power they reserved.
the risk is entirely transferred from the local homeowner to the balance sheet of the trillion-dollar tech developer.
Wow.
In fact, management argued that the sheer volume of this new load actually exerts downward pressure on transmission rates for existing customers.
Because if you double the amount of electricity flowing through the system, but the tech giants are paying for the upgrades, the fixed cost of maintaining the legacy grid is distributed across a vastly larger denominator.
Over time, residential bills should theoretically go down or at least stabilize
further.
Okay, so the Pennsylvania thesis is built on low latency, advanced transmission, and bulletproof tariff structures. But Kentucky is experiencing a massive demand shock for entirely different reasons.
Right. They updated their planning assumptions, and they are now projecting 3.5 gigawatts of expected new load in Kentucky by 2032.
Which is nearly double the 1.8 gigawatts they forecast in their most recent CPCN filing.
The Certificate of Public Convenience and Necessity.
Right. And when your demand forecast doubles in a vertically integrated market like Kentucky, where the utility owns both the poles and the power plants, you have a generation emergency.
Have to build new tower plants immediately.
And the nature of the load is different. While 1.2 gigawatts of their total Kentucky pipeline is data center demand, these aren't the latency-sensitive financial hubs.
No, these are the massive AI training clusters. If you were training a large language model for 6 months, it doesn't matter if the server is in Virginia or halfway up a mountain in Appalachia.
All that matters is access to cheap, abundant, 247 power.
And Kentucky provides that low-cost energy environment alongside a major industrial renaissance.
They highlighted commitments from Toyota Motor Manufacturing and Global Laser Enrichment, totaling $2.6 billion in economic investment.
This isn't just an AI story, it's a structural reshoring of American heavy industry.
Which forces PPL to aggressively rethink their generation mix. You can't just throw out a few solar panels to power a continuous process, laser enrichment facility, or a 1 gigawatt AI training cluster.
No, you need baseload. The two partnerships PPL announced on this call are incredibly telling about the future of the grid.
Let's hit the first one. They are evaluating a 266 megawatt pump storage hydro project in Bell County with Rye Development.
A pump storage facility on a former coal mine.
Walk me through the mechanics of how this actually solves the baseload problem.
It is essentially a massive gravity-driven water battery. Pumped hydro requires specific topography. You need significant elevation change.
Which they have.
By utilizing a former coal mine site, they already have the necessary geographic disruption. You build two reservoirs, one at the top of the mountain and one at the bottom.
Okay.
During the middle of the night, when system-wide electricity demand is incredibly low and power prices are dirt cheap, you use that cheap energy to pump water from the lower reservoir to the upper one.
You are converting electrical energy into potential energy.
Exactly. Then, during the peak daylight hours, when the industrial facilities and data centers are pulling maximum load and the grid is stressed, you open the gates.
The water rushes back down the mountain, spins a massive turbine, and generates highly lucrative peak power.
The CEO noted this project would provide up to 8 hours of dispatchable storage. It's a $1.3 billion project with a projected commercial operation date of 2031, but he highlighted a critical financial kicker.
The tax credit.
Right. It could be eligible for a 50% investment tax credit under the Inflation Reduction Act, specifically because it's cited in an energy community transitioning away from legacy coal.
That 50% ITC completely changes the financial modeling. It halves the capital burden on the utility while providing a hyper-reliable, zero-carbon, long-duration storage asset.
It's a perfect bridge mechanism, but, it's only 266 megawatts. To handle the 3.5 gigawatt surge, they have to look at nuclear.
Which brings us to the Xenergy collaboration. PPL is actively exploring the deployment of small modular reactors, or SMRs, in Kentucky.
Right.
The tech industry has made it abundantly clear. They need 247 baseload power. But their corporate boards have mandated aggressive carbon-neutral targets. You can't build a new coal plant, and natural gas still carries an emissions footprint.
Nuclear is really the only mathematically viable solution for a zero-carbon, always-on AI future. But traditional nuclear plants like Vogtle took decades and tens of billions of dollars to complete.
Which is why the SMR model is the only path forward. Instead of a bespoke, massive construction project that is plagued by cost overruns, SMRs like Xenergy's high-temperature gas-cooled reactors are designed to be manufactured in a centralized factory.
You build the standardized modules off-site and assemble them at the location. It drastically reduces the civil engineering risks and accelerates the deployment timeline.
And Kentucky is aggressively pushing for this. They recently enacted legislation establishing a nuclear energy development authority, including a $75 million grant program to fund early site permitting.
PPL expects their early evaluation costs to be less than the available grant money, which means they are exploring this massive technological leap with virtually zero upfront financial risk to the shareholder.
However, management was very disciplined in managing expectations here. SMRs are still largely theoretical in a commercial U.S. deployment context.
He emphasized a phased approach, strictly gated by economics and regulatory certainty. They are not going to bet the balance sheet on a speculative nuclear reactor.
The large load customers, the Amazons and Googles, are going to have to step up and sign massive long-term power purchase agreements to guarantee the financing before PPL commits a single dollar of core capital.
Which brings us to the absolute crown jewel of this earnings call.
Yes.
The initiative that fundamentally separates PPL from every other regulated utility in the sector. Let's dissect the Blackstone joint venture.
Because the data center pipeline in Pennsylvania is 28 gigawatts, but PJM, the regional grid operator, is facing a catastrophic generation shortfall.
PPL has the wires to deliver the power, but the wholesale market simply doesn't have the power plants to generate it.
The hyperscalers assumed for years that if they built a facility, the grid would magically provide the electricity.
That illusion has totally shattered. The interconnection queue in PJM is a nightmare. Projects are stalled for years.
So PPL recognized that if they rely on the broader market to build generation, their 28 gigawatt transmission backlog will never convert to revenue. So they stepped completely outside the regulated utility framework.
They partnered with Blackstone Infrastructure to create a dedicated GenCo, an independent power producer.
Instead of putting generation assets into the regulated rate base, this JV will go directly to the hyperscalers and offer a bespoke, behind-the-meter solution.
They're essentially telling the tech giants, if you want power in 2026, we will build a dedicated power plant directly adjacent to your data center, strictly for your use.
It bypasses the entire PJM generation interconnection logjam. And the structure of the JV is incredibly telling.
PPL didn't do this alone because merchant power generation is highly volatile, and regulated utility investors hate volatility.
By bringing in Blackstone, they secure the massive private equity capital required, spread the risk, and leverage Blackstone's unparalleled institutional relationships, while PPL provides the grid integration expertise.
During the Q&A, Jeremy Tennant from JP Morgan pushed hard on the timeline for this JV.
And the response was revealing. They are already engaged in strategic discussions with pipeline companies to secure access to low-cost Marcellus shale gas.
They are actively reserving manufacturing slots for heavy-duty gas turbines, and they are securing the necessary land parcels. This isn't a whiteboard concept. They are actively acquiring the hardware.
And when asked about the timeline mismatch, because permitting and building a massive combined cycle gas turbine takes years, but the hyperscalers want servers online, next quarter management laid out a bridging strategy.
The JV is prepared to deploy utility-scale batteries, fuel cells, or fast-start aeroderivative gas turbines to provide immediate localized power to the data center while the permanent massive facility is moving through the environmental permitting phase.
It is a fully customized end-to-end energy solution for the most demanding companies on Earth. But the most vital piece of data for the retail investor is the commercial structure.
Right. They reiterated that the JV will not break ground without signed energy supply services agreements, ESAs.
These will be long-term, utility-like contracts. They were not building merchant plants on speculation and hoping the price of power stays high. They are building to order with guaranteed margins.
And here is the kicker that makes the valuation so compelling. The current 2026 guidance of $1.94 and the 6 to 8% EPS growth target through 2029.
Yeah.
That entire financial model does not include a single dime of earnings contribution from the Blackstone joint venture.
Let me repeat that for everyone listening. The JV is pure, unadulterated upside. The core regulated business alone safely supports the 6 to 8% growth and the dividend.
If the Blackstone JV signs a single massive ESA with an AWS or a Microsoft this year, it acts as an immediate, unmodeled catalyst for the stock price.
Which brings us directly to our talk ticker's verdict.
All right.
We've torn down the Q1 financials, evaluated the regulatory friction in Kentucky, analyzed the historic PA rate settlement, and mapped out the staggering AI load growth and the Blackstone GenCo strategy.
That's a lot of ground covered.
It is. So taking all of that raw data and operational context into account, where do you land? Is PPL a buy, a hold, or a sell?
My stance is aggressively bullish. PPL currently offers a risk-to-reward ratio that is almost non-existent in the modern equity markets. You are buying the high floor safety of a meticulously managed, heavily regulated utility.
Management just proved they have the operational discipline to go a decade without a base rate hike, completely insulating them from the political blowback that constantly threatens this sector.
And that operational excellence secures a rock-solid 4 to 6% annual dividend growth target.
That is your baseline. The dividend floor is heavily protected by the structural execution in PA and the rider recovery mechanisms in Rhode Island.
Exactly. But layered on top of that defensive floor is the explosive, unregulated upside of a premier AI infrastructure play.
They hold the physical keys to the most lucrative data center market in the country.
Their advanced transmission grid allows them to onboard gigawatt-scale hyperscalers at a fraction of the cost and time of their peers. And the Blackstone JV positions them to capture the generation margin that the broader PJM market is fumbling.
So let's make it actionable for the listener. If you are currently holding PPL in your portfolio, what is the play?
If you hold it, you lock it away and let the thesis play out. Collect the reliable, growing dividend yield while that 28 gigawatt development backlog systematically clears the regulatory hurdles and converts into hard rate base revenue over the next 5 to 7 years.
Do not let the legacy boring utility label shake you out of an asset that is structurally vital to the tech sector's survival.
And for the investor sitting on the sidelines looking at the Q1 print and wondering if they missed the entry point,
Yeah, what about them?
the primary catalyst hasn't even happened yet. If you are considering initiating a position, you need to monitor the newswire obsessively for the Blackstone JV.
The moment PPL announces a signed binding agreement with a major hyperscaler, the institutional market is going to be forced to instantly re-rate the stock, because that is the moment the pure upside generation model becomes tangible, heavily contracted cash flow. The moment the market realizes they aren't just stringing wires, they are acting as the bespoke power plant for the AI revolution.
Precisely. It fundamentally alters the valuation multiple.
As we wrap up this deep dive, I want to leave you with a broader perspective to consider as you evaluate your overall portfolio. We spend an inordinate amount of time dissecting the software side of artificial intelligence.
Oh, constantly. The market argues over parameter counts, chip architectures, and which Silicon Valley giant has the superior large language model.
The media cycle is entirely focused on the digital abstraction of AI.
It's all they talk about.
But this earnings call forces us to confront the physical reality of the technology. AI does not run on abstract code. It runs on extreme, concentrated physical energy.
And right now, the global power grid is buckling under the weight of that demand.
You can design the most sophisticated neural network on the planet, but if the local utility cannot build a substation fast enough to feed it, that AI does not exist.
The capacity crunch is tightening every single day.
So ask yourself, as we move into the late 2020s, will the true economic power in the tech sector belong to the companies writing the software? Or will the ultimate leverage belong to the companies that own the transmission lines, the pump storage facilities, and the gas turbines keeping those servers alive?
The definition of a tech stock is actively being rewritten by the constraints of the physical world.
The market landscape is shifting beneath our feet. Keep analyzing the data, keep questioning the consensus, and look for the companies holding the physical keys to the digital future. That's our breakdown of PPL's Q1 print. Thanks for joining us on Talk Tickers.